In this podcast, I will be discussing foreign exchange transactions. Now, what is foreign exchange transactions? A taxpayer can enter into various transactions in a foreign currency, and the amounts of the transactions must then be translated into South African currency or rands to determine the effect of the transactions on the taxable income of the taxpayer. If gross income was therefore received or accrued to a taxpayer in a foreign currency, or tax-deductible expenditure was incurred in a foreign currency, such amounts must be translated to rand using the rules stipulated in Section 25D. If expenditure was incurred for the acquisition of an asset, the cost of the asset must be translated to rand in order to calculate any capital allowance and or recoupments by using Section 25D. If an asset was acquired in a foreign currency and it is subsequently disposed of, the capital gain or loss must be calculated, and there we use paragraph 43 of the 8th schedule. And the exchange gains or losses arising on these specific exchange items must be calculated and included in or deducted from the income of the taxpayer by applying the rules of Section 24I. In this diagram, we just want to highlight the fact that each foreign exchange transaction consists of two parts, namely the income or the expense, or even if you acquire an asset, and then the exchange item. So for the income and the expense, we will deduct the expense or include the income by converting the amounts to rand. For an asset, we will claim a capital allowance by converting the cost to rand. And then there will also be a capital gain or loss, which will be for paragraph 43 of this specific asset. And then for the exchange item, we will deduct the exchange loss or include the exchange gain under Section 24I. Let's take a look at the specific definitions. Your average exchange rate will be the rate in relation to a year of assessment, which is determined by using the closing spot rates at the end of the daily or monthly intervals during the year of assessment. Your spot rate is the appropriate quoted exchange rate at a specific time by any authorized dealer in foreign exchange for the delivery of currency. Your transaction date is the date on which the debt is actually incurred or when the unconditional liability to pay the outstanding amount arises. Your translation date is the last day of a year of assessment on which an exchange item is required to be translated, and your realization date is the date on which the exchange item is realized or fully paid. Let's look at the computation of these exchange differences. Your exchange item is EI, your exchange rate will be ER, your transaction date will be referred to as TAD, the realization date will be RR, your translation date is TLD, and then the year of assessment is YOA. All right, the first one says an exchange item that is acquired and realized during the current year of assessment. So your exchange difference will be the exchange item multiplied by the exchange rate on the transaction date during the current year of assessment, less the exchange rate at which the exchange item is realized during the current year of assessment. The next one says your exchange item is acquired but not realized during the current year of assessment. Therefore, your exchange difference will be your exchange item multiplied by the exchange rate on the transaction date during the current year, less the exchange rate at which the exchange item is translated at the end of the current year of assessment. The third one says your exchange item is acquired in a previous year of assessment and realized during the current year of assessment. The exchange difference will be the exchange item multiplied by the exchange rate at which the exchange item was translated at the end of the immediately preceding year, less the exchange rate at which the exchange item is realized during the current year. And then lastly, your exchange item acquired in the previous year of assessment but not realized during the current year of assessment. There your exchange difference will be the exchange item multiplied by the exchange rate at which the exchange item was translated at the end of the immediately preceding year, less the exchange rate at which the exchange item is translated at the end of the current year. I'm going to work through an example with you. Let's read through the example. Sample Pty Limited is a company that manufactures solar panels and inverters. The company's year of assessment ends on the last day of March. The company is registered as a Category B value-added tax vendor making 100% taxable supplies. The company's manufacturing process has been approved by SARS as a qualifying process of manufacture, and the company is not a small business corporation as defined in the Income Tax Act. On 1 December 20XX, the company purchased a new and unused manufacturing machine from a supplier in America for $150,000 US. The machine was shipped free on board on 10 December 20XX. The machine is delivered at the company's premises on 26 March 20XY, the following year, and brought into use on the same day. The machine will be used in the approved manufacturing process of Sample Pty Limited, and the purchase consideration is settled in full on 30 June 20XY. Assume that the spot rate on the relevant dates are as follows. We've got the one on 1 December 20XX, 16 Rand 70, 10 December 20XX, 1684, 26 March 20XY, 1698, 31 March 20XY, 1705, 30 June 20XY, 1675, and the average exchange rate for the 20XY year of assessment is 1690. The required portion says, calculate the exchange differences and allowances applicable of Sample Pty Limited for the 20XY and the 20XZ, which is the following year of assessment of the 20XY year of assessment for those two. Let's work through the solution to the example. Let's start off with the 20XY year of assessment. First of all, we need to work out and determine the cost of the machine. The purchase price of $150,000 US must be multiplied with the 16 Rand 84, and this is your transaction date, and this is when the machine was shipped free on board on 10 December 20XX, and therefore we multiply the 1684 with 150,000 Rand to get to the 2526000 purchase amount of the machine. Now we know, because this is not a small business corporation, we are allowed to claim a capital allowance, your normal section 12C capital allowance, and on a new and used machine you can claim 40% in the first year and 20% in the following 3 years. Therefore, we can claim the 40% on the 2526000, and we can deduct the capital allowance of 1010400 for the current year of assessment. Now we move over to the foreign exchange loss in respect of the 20XY year of assessment. If we take the $150,000 US, we need to multiply it first of all with the 16 Rand 84 cents, which is your transaction date, and that was the 10th of December, and we need to deduct the 17 Rand and 5 cents, and this is your translation date, which is your end of your year of assessment, 31 March 20XY. Now, the reason is we need to determine it for this specific year of assessment, and the payment was only made in the following year of assessment, the 20XZ year of assessment. So therefore, the foreign exchange loss for the 20XY year of assessment will be 315,000 Rand. We then move over to the following year of assessment, the 20XZ. First of all, we can claim another capital allowance because this is your second year for the machine, and you can claim 20% on the 2526,000, and that gives us an amount of 505,200. And then now, because the payment was made on 30 June 20XY, we need to determine the foreign exchange gain in respect of the 20XZ year of assessment. So that will again be the 150,000 US dollars multiplied by the 1705. This is your translation date, in other words 31 March, at the end of your previous year of assessment, less your realization date, and this will be the 30 June 20XY, and that is your 16 Rand 75. Okay, there we get to a foreign exchange gain that must be added to your 20XZ year of assessment of 45,000 Rand. The literature I consulted for this vodcast is A Student's Approach to Taxation in South Africa, as well as Silk, South African Income Tax. Thank you for listening to the vodcast. I hope that foreign exchange transactions are now more understandable.